With President Trump rolling back tariffs again and economic growth still looking reasonably healthy, the Fed's road ahead suddenly doesn't look as bumpy. Joining me to discuss is Goldman Sachs Vice Chairman and former Dallas Fed President Robert Kaplan. It's always good to see you. Welcome back.
Good to see you, Scott.
Is that a fair assessment of what I wrote? That the Fed, what looked like potholes everywhere suddenly is like, all right, we filled them in for a little bit.
Well, if the Fed had been worried about likely recession or unemployment spiking up, I think that looks somewhat less likely. One of the reasons for that is the labor force is tighter than people may have thought. Change in immigration policy is part of that story. In addition, the tax bill and the whole fiscal outlook, we thought 3 months ago, 2 months ago, was likely to be contractionary. And it may turn out to be more stimulative. It means you're going to have maybe higher deficits, not lower deficits. And we are starting to get some clarity on the tariffs, where at least from the high April levels, there's a hope that they may settle out on average in the low to mid-teens. So all of that is altering the picture. It still means the Fed will likely, I think, skip June, and I think most likely skip July, but the strategy of waiting for the situation to clarify, I think, has been the right approach, and it's still the right approach.
I mean, is there a chance the Fed does absolutely nothing this year because of everything you just said?
There's a chance of it. And, they've got a chance to indicate their views for the year in the June summary of economic projections. Each Fed participant will have to submit their forecast. If I were in my old seat, I would probably submit one or two. But yeah, they're going to take it one meeting at a time, and I don't think they're going to prejudge it. So all those options are on the table, but I also think they're open to cutting one or two times, but they're not ready to judge right now.
Gosh, this makes Jackson Hole all the more important, even though it always is, obviously. But is that how I should be thinking about this?
Well, they may discuss the new framework more at Jackson Hole than they'll talk about the monetary outlook. I think by the time they get to Jackson Hole, it'll be later August. You'll probably have more clarity on the tariffs. You may well have already passed the tax legislation. So they'll have a little more clarity, and I think Jay Powell will adjust his comments accordingly. And then they'll talk about the new framework and adjustments they're making to the new framework they're working on.
If we're content with the patience that the Fed obviously feels it has, if they do something in September, is it because they can or because they have to?
No, I think there was a scenario if unemployment had started to spike up, that might have forced them to be more forward-leaning. I just think that scenario is less likely, again, because of a tight workforce and maybe more expansive fiscal policy than they had expected. And so I think the reason if they do move in September, I think it's more likely because we will have processed the early stages of tariffs, and they will be less inflationary than the Fed had feared. But even September may be too soon to make that judgment. But I don't think they're going to get forced. I think they're going to have to make sure they're confident that they understand the impact on prices of these tariffs, and I don't think they have a grip on that yet.
How nervous were you getting, and thus how nervous do you think Chair Powell was, if that even is the right word, and maybe it's too strong or dramatic, about the backup in yields, especially at the longer end, and what that could signify?
Well, I think that is concerning. And I'm sure it concerns more than Jay Powell. It concerns the Treasury, because we now have in the neighborhood of $37 trillion of debt on its way to 38 by the end of the year and heading north. And when we started the administration and when you and I first spoke, we had Doge, and I think the thought was we'd at least extend the Trump tax cuts, but may not be able to do much more than that. And there was going to be a real effort to chip away at the deficit, which is running in the neighborhood of 7% of GDP. I think that appears somewhat less likely now. And I think the bond market is recognizing that. And that's why you see the 10-year yields are sticky. And also, you see, there's also been some weakness in the dollar, some strength in gold, which also is not terribly helpful for duration buyers. So we could get a scenario here where economic growth is okay, maybe not great, but not a recession. Unemployment stays low. Corporate earnings, not perfect, but stay resilient. But the one lingering issue is deficits are still running at 7% plus of GDP, and the 10-year rate is sticky, and that'll be the issue to be concerned about.